Thanks for tuning into BloombergQuint. Well, late last year, the OPEC decided to cut output production by 1.8 million barrels per day. Ever since, prices have been on a seesaw ride. Later in the day, the OPEC members are scheduled to meet to decide if they want to prolong that cut. To give us more insights, we are now joined by Vandana, founder and CEO of Vanda Insights. Thanks for joining us, Vandana.
You're welcome.
Let me start off by asking you, crude oil prices have rebounded about 17% from the low point of May. So, what's the sense that you're getting in terms of what's driving the prices?
Yeah, this week, all indications are that OPEC and the 11 non-OPEC producers who've been collaborating with them in the cuts that you just mentioned will extend the cuts for another 9 months, which means from July all the way to March 2018. And that has given a huge psychological boost to the markets. I think a lot of the bullish speculative positions are back. They had been winding down in recent weeks. As you mentioned, we'd seen a lot of volatility in oil prices. But essentially, we remain in an oversupplied market. And now the expectation is, as long as these cuts continue, we haven't seen much of a drain in inventories so far, not in the first quarter of this year, but hopefully the inventories will drain and the markets will return to a more balanced position.
Okay, so going into the OPEC meet, actually, it seems that more or less the 9-month period extension is priced in by the markets. But what are some of the key aspects that you would be looking for in the outcome of the meet?
I think compliance has been and will remain a critical issue. There's really no point if OPEC can't impose a good discipline with the cuts. Now, it surprised the markets greatly. Starting from January, I think the compliance levels have been high. Within the non-OPEC group, it's a little more tricky to impose that level of discipline, but I think one of the things is definitely they will be reiterating to each other. I think some of the members have been a little less compliant. They have not yet reached the 100% of the cuts that they had pledged. So that is definitely one. I think there might be some discussion also about Nigeria and Libya. These are the two OPEC members who have been exempted from the production cut. And there's a little bit of worry amongst market watchers that especially Libya, whose production has risen by nearly 300,000 barrels per day in the past few weeks. So what happens, could that start offsetting the cuts? So from all indications again are that these countries will remain exempted, but clearly I think there's some discussion needed about what to do with that. And of course, the big question mark about which OPEC can't really do anything but monitor is what's going to happen to US production.
Okay, so on the US production, do you think that the US inventory levels will be able to, challenge the OPEC meet?
See, the reason the market is very squarely focused on inventory levels is first and foremost, OPEC has set that as a target. So when OPEC said, OPEC doesn't have any price targets anymore. You might hear ministers saying that, we would like very much for prices to be between 50 and 60, but in terms of actual goal, they have set the goal that oil inventories globally, which have been, way above 5-year average, really bloated, oversupplied, overhang of oil, can we bring it back to 5-year average levels? So that is OPEC's target. Now, of course, in keeping with that, and the market does want to believe that OPEC is adhering to its cuts, that amount of oil is being removed, not 1.8, maybe 1.6, 1.7 is being removed, but the actual proof for the market, the tangible evidence is going to be in the form of inventories. Now, the inventories, when you talk about stocks, they exist globally in OECD as well as non-OECD. But the non-OECD world is a bit of a dark area. How much is there exactly in floating storage? How much is stored in China? Nobody can say for certain. So people look at OECD stocks, but again, those come with a bit of lag as well. So what happens is the attention goes very squarely on US stocks because that's the most dependable and the most frequent data. So that gets used as a proxy. And after all, US is the biggest consumer. It has a big section of the OECD crude and product inventories are in the US. So I think once the dust is settled over this OPEC meeting next week, you can fully expect the market to again go back to tracking to what's happening to stocks in the US.
Yeah, you spoke about China. So what kind of demand supply situation do you see for India, China, or for that matter, rest of the world planning out?
Yes. So you have, I'm sure, very commonly heard it being said that oil is completely a supply story, I think this year and presumably for next year as well, which doesn't mean that the demand side of the equation has dropped off. It's after all, the whole thing is demand and supply. The reason demand is not being discussed much is that there aren't expectations for demand to move up or down significantly. Last year, I think the consensus view, if you look at IEA, OPEC, EIA data, is demand grew by about 1.7, which is relatively healthy demand growth in 2016 year on year. This year, most agencies and analysts have moderated their expectations for demand growth. And of course, as you mentioned, China is a very important part of that. Now, for the longest time, for the past 10, 15 years, China was the main engine of demand growth. Even today, China is the second biggest next to US oil consumer. So it's got a big base, nearly 11 million barrels per day of consumption. Chinese demand is moderating. Chinese experts that I speak with say that definitely the country is past its gas oil or diesel demand peak. They even wonder if the gasoline peak might be, somewhere around the corner. So as China pivots its economy away from industrial and export-driven growth to more services and domestic services and domestic demand, its energy intensity is climbing down as well. So the new normal for Chinese oil demand growth is more like 2 to 3% year on year. But let's not forget, it comes off a big base still, relatively big base. So 2 or 3%, China is still adding about 2 to 300,000 barrels per day of demand.
Okay. Yeah, so OPEC, does not give price targets as such, but there are analysts on the street who have estimates, and in fact, a couple of weeks back, I was talking to one analyst, and he quoted that he was looking for a $60 target price. Do you have any target prices on the crude oil for 2017?
I think OPEC themselves would be very happy if they can maintain at 50 to 60. I have reason to believe that 50 is a hugely psychologically important number. Otherwise, there's nothing very magical about it. I think it feels to me that OPEC wants to defend a floor at that level. 60 might be a bit of a stretch in my view, because US oil production is already into fourth gear. So just from the start of this year to now, it has risen by nearly 500,000 barrels per day. So I feel that's a counterbalancing force essentially to all the cuts that are happening. So conceivably, as WTI, let's say, goes to mid 50s or Brent goes to high 50s, that could unleash another bigger wave of US production growth, which is why I think that's where probably even below 60 is where a cap might be.
All right. One last question. Do you want to leave us with any food for thought for the energy markets?
Yes, I think let's take a step back from we tend to look at oil markets in a very short-term perspective, of course, which is very interesting. But let's take a step back. I think some phenomenal big changes are happening in the oil markets, around the oil markets. I mean, a day doesn't go by when you don't read stories about electric vehicles, new renewables targets in China and India, autonomous vehicles, the sharing economy. What is going to happen to diesel, gasoline, transportation fuel demand if people decide, I don't need a car, I'm happy to share one, right? So I think oil and gas companies, that's the single biggest challenge they're facing today. The challenge yesterday or last year for them was, can we find and produce oil at $50? Now these companies are saying, how can we make ourselves future-proof? So all the R&D is going from these companies actually going into renewables. And here's where I think technology, just like it did with shale, technology can surprise us again in a big way. I would caution against thinking that there's always going to be a linear growth in renewables and electric vehicles and things like that. I think technology has the capability to revolutionize instead of leaving things to evolution.
All right, so that's the word coming in from Vandana. Oil is going to be a supply story. Thanks a lot for joining us, Vandana.
You're welcome.